In this video, we're going to talk about margin. And this video is going to be quite short. The next couple of videos are going to be quite short. They're going to be talking about things that you're going to find inside your platform, whether you're trading equities or cryptos. Every platform is going to have this. They're very, very simple concepts, but I want to make sure they're covered so you know exactly what they are. And let's start off with margin. And margin is really essential to keep your eye on for trading. You're going to look at it every single day, regardless of what you're trading. And it's the amount of money or that collateral, whether it's US dollars, euros, cryptocurrency, it doesn't matter. Whatever you have to put into, deposit to your broker or to an exchange in order to cover the credit risk that the holder poses for that broker or exchange. Okay, making sure it's the broker making sure, or the exchange making sure that they're covered. Okay, in case something goes horribly wrong with your positions, that's margin. And margin requirements are different. Whether we're talking if you're a stock trader, okay, you're gonna have different margin requirements than if you're trading options, equity options, and if you're trading crypto. All these things will have different margin requirements according to the level of risk they present to the broker or to the exchange. So when you're trading through a traditional brokerage account, that broker is going to have a specific requirement for the amount of money that you need to have in that account. It also means that for certain types of trading, you would have different types of margin requirements. So with a typical online brokerage account, for example, different trading strategies or access to those strategies, such as selling naked options, with no protection, with unlimited risk potentially, are going to require different margin levels according to that risk they present to the brokerage. And that just makes sense. If you are a broker and you're allowing people to take on positions that have unlimited risk, well, you're going to need more margin. So if something goes horribly wrong, you're not having to pay for them. So when you buy an option, you must have the full amount covering that purchase. Now remember, when you buy an option, you have limited risk. If you pay $100 for an option, that's the most you can lose. It doesn't matter if it goes against you by a gazillion dollars. It does not matter. The most you'll lose is that $100. It's limited risk. So for the broker, they're just saying, hey, yeah, just put up the amount that it costs for that option, and we're good. But when you're selling options, you require more margin in order to protect the broker or the exchange, because selling options entails a little bit more risk. And of course, we haven't gotten into how to mitigate that risk yet, but we will. But just in generally speaking, when you're selling options, you're going to have to put up more margin because there's more risk to the broker. Now, most trading platforms are going to display margin use, like boom, right there in front of your face, like on the dashboard user interface. You're going to see it all the time. So it's never usually going to be any kind of a mystery that you have to investigate or do calculations. It's right there. And it's very handy to know where your margin use is at a glance in order to make any adjustments. So as you're going to learn, road traders, we like to keep our margin use below 30%. I can see it at a glance. If it starts getting up to 40%, 50%, okay, I know I need to reduce my risk or adjust positions in order to decrease the amount of margin. We'll talk about that in later videos, the things you can do to reduce your margin requirements. So let's just say that you're short some options and the market moves against you. So we sold some calls, boom, and the underlying price moves up. You can get into trouble pretty darn quickly. If you exceed your margin, which we like to keep at 30%, boom, goes up to over 100%. Oh boy, the broker or the exchange can limit you to putting in only orders that would reduce your margin, or they can even come along and they might start to incrementally close out positions in order to reduce that margin. So that's not a situation that you want to get yourself into. That's why monitoring that and being responsible and keeping an eye on it is just a good thing to do all around. And your trading platform is going to show you the maintenance margin and what that is, so you can avoid having what's called a margin call, where they're saying, hey, we need some money, what's going on? Or you need to reduce your positions or adjust positions so that your margin comes down. We don't ever want to put ourselves in that situation if we can avoid it. Okay, maintenance margin, as I mentioned, is the margin required to maintain your current positions. So if your margin balance falls below the maintenance margin requirements, your position may be incrementally liquidated by the broker or the exchange until that maintenance margin is lower than your margin balance. So both margin and the maintenance margin are usually shown right on your platform. Again, it's usually right on the interface at an account level as well as a position level. So you'll see which positions are causing you the most grief, and you'll see your overall margin for your entire account. And hey, your margin use is going to fluctuate as that underlying position moves. I mean, it only makes sense based on an open position. So you've got some calls, some puts, you've done some different things. Well, the underlying price of those assets is going to move around, and your margin is going to fluctuate minute to minute, day to day. So, you just want to keep an eye on it. If we can achieve that goal while using as little margin as possible, that is the ultimate goal. We want to risk as little capital as possible to achieve our goals. And the other nice thing too, and something that we're going to talk about in the future, and the reason why we don't like to go over 30% margin is we're keeping our powder dry, so to speak. So let's say there's a big event and a big move in the underlying asset that we happen to be holding, and our margin goes from 18% use up to 40% use. Well, we had that extra margin, and we can make our adjustments. We can do things to offset that. We can take advantage of situations too, because if we have some extra margin, the market makes a big move, it would suck to be out of margin and not be able to take advantage of that move and just be at its mercy. So it's important to always keep some spare margin, and it's responsible. And as we learn about rolling out options, when we're fixing positions or we're just rolling them out to keep earning theta, that's fine. You can do that forever. You can roll those options forever if it's going against you until you run out of margin. So monitoring your margin use is extremely important. And it is something we look at daily. If we're constantly adding or closing positions, we're going to see as we're making adjustments or as things expire, whatever, our margin requirement is going to change. So it's important to keep our eye on it day to day. Now, as I mentioned, the rogue trader rule of thumb when it comes to margin is to keep it below 30%. So in the event of a really significant price move, if we have an open position, there's a very significant price move of the underlying, our margin use might get gobbled up a little bit, but it's not going to trigger a margin call or force us to close positions. And it, of course, will allow us to take advantage of that move. Maybe there's things we want to do. It would suck if all our margin was used up. We're like, oh man, if only I had some margin, I could do this and I could, offset this. Whatever your trading strategy happens to be, it's always nice to have options available to you. If you use up all your margin, you've got no options except to close things out, and you're really at the mercy of the market. And we don't want to do that. So buying options, as we kind of mentioned at the very beginning, is going to use very little margin, because you have limited risk. You buy an option for $100, that's it. That's the most you can lose. All you need is $100 of margin, and you're covered. Selling options uses a lot more margin. As you'd expect to, defined risk strategies, and we'll get into these strategies later on in further videos, are going to use less margin because they're limited risk. They've got a defined risk, right? So the margin requirements are going to be lower for them. So in the case that you wanted to sell a call, for example, that would use up a fair bit of margin, because if you're selling a call, it has unlimited potential losses, because if it goes against you, the underlying price could theoretically go to infinity. We won't go to infinity, but it has unlimited losses. That's going to use up a lot more margin. So if we want to reduce the margin uses, we can instead sell a vertical spread. Okay, so we're selling that call, but we're buying a call at a higher strike price. We can consider that insurance. So if it goes above the higher strike price, those gains from the higher strike call will offset the losses from the lower strike call that we sold. This is one of our primary strategies we're going to get into in later videos. And really, it's just capping our loss. It's limiting our risk in the event that the trade doesn't go our way. So the margin requirements are going to be lower, reflecting that defined, that limited amount of risk. The broker doesn't need a whole bunch of margin, because they know exactly what our maximum loss could be when we've got that spread position on. And with any defined risk strategy, the margin requirement won't change as that underlying price moves around, versus a naked short, for example. If you're a naked short, you sold a short call and the price keeps going against you and going against you and going against you, it's going to gobble up margin, garble up margin, garble up margin. If you've got the defined risk strategy, it could go way against you, back it for you, against you. The margin's not going to change, because you've got that limited defined amount that you could possibly lose if it didn't go your way. That's a nice way to sleep at night, not having to worry about that. Trust me. So we're going to keep you guys safe with limited risk strategies. And that's it for margin. I'll see you in the next video.
Yeah, so all of the metrics you're going to be looking at, then margin use is probably the most important. Well, actually, it's the most important, no question. So you can think of the amount of free margin you have as how much air is in your tank and you're underwater. So with options, as we mentioned, you can make mistakes and you can actually take, shall we say, impermanent losses or short-term losses. But actually, if you have enough margin, you can always trade out of a bad position into a better one. So if let's say you're short a call option and the price has gone up and you're now in the money and you've got maybe a week to run on your option, you can actually trade time for strike. So you can make a few trades in order to simulate the effect of moving the expiry of that option out a month and up maybe 20% in terms of the value of the underlying. So you can get ahead of the market and keep that option out of the money. But you can only do that if you have spare margin, because essentially what you're doing is crystallizing the loss and then moving that loss into a longer term bet, hoping that eventually the bet will come good. And there is plenty of to say about people on roulette tables who continually double up on a loss in order to win back their won. It all works well until the house limit runs out, and it works well in options too, much more softly, because the house limit is actually how much margin you have, and it doesn't get used up quite as aggressively as your cash in a casino. But it's a similar principle. You want to give yourself some room to breathe so that you can trade out of a bad position and always try and keep the positive theta flowing in order to make your position good. Yeah, so you can think of margin as another form of optionality. It's giving you options on massaging your book in order to get a losing, uncomfortable position into a more comfortable one where you feel that you're going to win.
Okay, so margin is something that we got to pay attention to all the time, and we have certain rules on our margin use where we try and keep it in check. But I think it's important for people to understand that margin is going to be different for everything. If you're just trading some equities, okay, it's going to be different. If you have an options account, if you're only buying options versus if you're starting to sell options, your margin requirements are going to be higher because you represent more risk to the exchange or to the broker.
Yeah, it's worth saying that margin is your kind of hard stop, and when you run out of margin, you are going to get closed out. So that's when you actually crystallise your losses if you're making them. So margin management is incredibly important, and we will teach you all about that in the course. But it's also worth saying that with options, margin can always be managed. There's always a way to put more trades on, or take some trades off, or reposition some trades. We can put some risk reversals in, or some collars, or we can buy some strangles, or whatever we need to do. We can always bring that margin use down as long as we are vigilant and not too greedy. In terms of the way that the exchange calculates your margin, or the broker calculates your margin, it's actually pretty simple. There's some complication in the execution, but the principle's simple. They simply say, okay, given the current market conditions, what's the value of your account? What if we did a what-if scenario? Let's have the price of the underlying stock go up or down by 15%. Let's have the volatility of the options go up or down by 40%, and a matrix of like all of those, so like there's 9 different outcomes, 3 by 3. And what is the effect on your portfolio if any of those happen? Pick the worst one, and then the difference between your portfolio value on that worst scenario and now is your margin requirement. That's pretty much what margin is in a nutshell.
Mm-hmm. Yeah, and it's just the brokers or exchanges protecting themselves. They're like saying, okay, what's the worst case scenario so that we don't lose money from somebody else's actions, right? It's just sort of their due diligence and keeping themselves in check and safe.
Yeah. So what the broker cares about is can he make sure that you are solvent at least overnight, because then he can deal with the problem tomorrow with you.